Hello everyone, my name is Jerry Yu, the Family Money Doctor. In my last video, I explained how RMD, which is required minimum distribution, is calculated. The IRS requires you to start withdrawing funds from your pre-tax retirement accounts starting at age 73. Because the money in qualified retirement plan has never been taxed, therefore, every dollar you withdraw from retirement accounts is subject to income taxes. Moreover, the design of RMD is such that the percentage you need to withdraw increase every year with age. I also mentioned that at age 73, the required withdrawal amount is calculated by multiplying the total value of your retirement account by 3.77%. I'm going to raise another concern. Let's say that you or your investment broker are doing a good job with your retirement plan and you are getting annual return of 8% net. Okay, even after withdrawing 3.77%, your asset will still grow by the net rate of 4.23%. Please pay attention here. If our investment returns are good, minus the RMD percentage, our retirement plan are still growing at a very healthy percentage rate, which means the dollar amount in our retirement plan could become astronomical when we reach age 90. Considering that RMD rule requires us to withdraw 8.2% at that age, there is a very high possibility we will be in the highest tax bracket. And let's go in a different direction. If we passed away prematurely, leaving substantial retirement account balance to our children, in that scenario, the result might be even worse. Why? Before I explain why money in retirement account is the worst kind of estate to leave to children, I would really appreciate it if you can hit the like or subscribe button or save this video for future references. Okay, why is retirement account is the worst kind of money to leave to your children? For example, Mr. and Mrs. Jones, after retiring at age 73, withdraw their retirement funds annually according to the IRS RMD requirements. However, because Mr. Jones is good at managing finances and their retirement money grows tax deferred and compound a very healthy rate of return, when Mr. Jones and Mrs. Jones pass away, there is still $8 million left in their retirement account. Will the $8 million in their retirement account be subject to income taxes upon their death? Absolutely. They will have to file their final income tax return after death. There are two ways to handle the final income tax return. The first is to tax it at Mr. and Mrs. Jones' tax rate. If they are unfortunate enough to live in California, the combined federal and state tax could exceed 50%, leaving less than $4 million. And this $4 million is also subject to estate tax, along with their other real estate investments, investment outside of the USA, business ventures, stock, and mutual funds. If their global total asset exceed the estate tax exemption limit, the remaining $4 million in the retirement accounts will be face additional estate taxes, reducing it to about $2.4 million. So if Mr. and Mrs. Jones do not want to leave their inheritance to their children, but they wanted to leave it to their grandchildren, skipping a generation, there is an additional generation skipping tax. So after a lifetime of hard work and saving, the $8 million in retirement funds could end up being less than $2 million for their grandchildren without proper planning. The other option for handling taxes after Mr. and Mrs. Jones passed away is their children will spread the remaining retirement account balance over 10 years. If there's $4 million left in the retirement account, the children could possibly receive about $500,000 to $700,000 annually, including interest. Right? This amount is then taxed at the children's income tax rate. Usually, when we passed away, our children are around age of 40 to 60 years old. See, they will be in their prime earning years. Unfortunately, and this is when their income tax rate are at the highest. Besides their own income and investment income, the additional $500,000 to $700,000 from your retirement account could significantly increase the children's tax burden. When we have sizable retirement account balance, it is great that we do not have to worry about our own retirement and our children can inherit our leftover money. However, under the US tax law, the more you leave, the more taxes they pay. So, is there a solution? Should we need to plan ahead? See, since each family situation is different, I recommend sitting down with your accountant and your financial planner to find out the best strategies for your family. Essentially, you should consider strategies to keep your retirement income lower. Or you might say, I'm retired. How can I still have income? Indeed, after retirement, you will not have earned income. But don't forget your passive income, such as Social Security, investment income, and rental incomes. These can be substantial. So what should we do? If your bank saving and other investment incomes are sufficient, considering delayed Social Security benefit until age 70. And after retirement or after age 59 and a half, considering systematically convert part of your IRA and 401k funds to a Roth IRA. So if you convert $1.8 million from a $3 million retirement plan, leaving only $1.2 million in pre-tax account with a future compounded interest could be less of a tax problem. Moreover, the earning on the converted Roth IRA funds are tax-free and there are no future RMD issues. But you might say, hey, my CPA tells me that even in retirement with good investment and rental income, converting to a Roth IRA now would mean paying more taxes. See, an experienced financial planner would tell you to look at the whole picture. Consider every option. If you have rental income, we will suggest finding a way to reduce rental income to a minimum. If rental income is stable, considering taking out loan to offset taxes with interest deduction. See, increase your depreciation strategies to lower rental income. For investment income, considering using annuities within your retirement accounts. And if you are relatively young and in good health, consider purchasing life insurance. See, because properly designed life insurance policy grows tax deferred, and future cash value can be used tax-free. Moreover, the death benefit to beneficiary are also income tax-free. By systematically doing asset allocation and tax planning now, using IRS-provided tax deferral tools, you can reduce future RMD problems. Also, the money left to your children after you passed away won't be a big tax issue. And I hope these two videos on the RMD help you understand more. If we look at RMD alone, it seems like a big problem. However, with an overall strategies and complementary tools, it is easily manageable. So thank you for watching today's video, and please remember to like and subscribe, and I will see you in future videos.